So we are jumping into taxation of employment income after introducing income tax. Last time we were here, last week. So we are going to focus on Section 19 of the Income Tax Act, which provides for the taxation of employment income. And as part of our discussion, we shall be looking at the meaning of employment, who is an employee, who is an employer, what is employment income, chargeable employment income, benefits in kind. Okay, so we start with the meaning of employment in line with the tax law. And here we're saying that employment is the position of an individual in the employment of another person. Employment refers to a directorship of a company or a position entitling the holder to a fixed or ascertainable remuneration, the holding or acting in any public office. So this is how the tax law looks at employment that we are discussing this evening. Position of an individual. This is number one. Position of an individual in the employment of another person, which is, I think, the largest form where you receive an appointment letter appointing you to a position, manager, officer, As you're going to see, the appointment can be written or even verbal. Then the least appreciated from experience is that number two, directorship of a company. Many directors have not appreciated that they are under employment, especially those who start the company. So they start the company and they feel they are, they are now entrepreneurs and they have jumped employment. So they move money as and when they want, not knowing that they are employees of the company that they have started. So the tax law brings the directors of a company into the employee bracket, and thus they are supposed to pay taxes just like any other employee. Then in number three, we see another form. These are now guys that are working for the company. Now, this may not be a formal appointment, but we see these people working and, receiving compensation for their time, which may not be fixed, but it can be ascertained. Then in number four, we see the tax law bringing into the employment definition those who are holding public office. I think most of you here working for ministry, local government, agency, etc. So all that is employment. Then the employee is a person that is engaged in the four forms. Your contract can be a written one, verbal, or even implied. That is an employee. Then the employer is the person who employs or remunerates the employee. And this is all under Section 2 of the Income Tax Act. So according to the tax law, of course, we see the employee earning employment income in form of payments coming from the employer, in form of advantages due to their position as an employee, in form of benefits in kind, again due to their position as an employee, in form of allowances, again for compensation of their effort to work, in form of facilities. So the tax law considers all this as the source of employment income that is considered for taxation. Without that position, you wouldn't be in position to earn that salary, enjoy the facility, derive the benefit, enjoy the advantages, derive the money through allowances. If you lose that position today, that all goes away. Meaning that we have two types of citizens, those who are deriving this and those who are not. And from the theory of taxation, to be more specific, Adam Smith, it is reasonable for a state to compel those who are deriving this contribute to the government so that the government can provide for all. So that's why you will pay taxes if you earn, and you don't pay taxes if you don't earn. The taxation will depend on your resident status. And since employment is in regard to individuals, here we are not going to talk about companies because a company cannot be employed. It's only individuals that are employed. So the issue of resident individual, we have seen that in the previous discussion we had. And here we're saying that the resident individual is going to be assessed for tax on their worldwide employment income, meaning that you're going to be taxed from all geographical sources of employment within and outside Uganda. Of course, as you may all know, all states subject income to tax. So there's no way you're going to earn from a country and you don't pay taxes in that country. So in the second bullet, we are saying that due to the fact that you are likely to have paid taxes on that employment income you've earned outside Uganda, if that evidence is enough in form of a tax credit, in form of a tax certificate, you will receive a tax credit for any taxes that you have paid on such income. This second bullet is addressing the issue of international taxation. International taxation, which is also provided for under the Income Tax Act, puts forward relief for all those individuals that have earned outside Uganda and have paid taxes on that income. So that avoids double taxation. But the default is that if you've earned income from other sources outside Uganda and within Uganda, and you meet the criteria of a resident individual, you have to pay taxes on all those, on the income from all those sources of employment income. When it comes to the when it comes to the non-residents, non-resident individuals, these are assessed for tax on employment that has been on employment income that has been derived from sources in Uganda. So you remember we talked about resident, non-resident, and I think we were able to appreciate the criteria that if you have a permanent home in Uganda, you're a resident. If you have been present in Uganda for 183 days or more in the year of income, qualified to be resident, and on average, 3 years, including the current year and the past 2 years. If the average number of days you've been present in Uganda is equal to 122 or more, you are referred to as, you qualify to be a resident individual. So if these fail, then you are non-resident. So you can revisit that if you have forgotten who is resident, who is non-resident. So the tax law defines or gives the provision for who is resident, non-resident. So that is going to affect the assessment of tax, and the taxation will not be the same for individual, resident, and non-resident individual. Section 19, subsection 1, part A of the tax law lists essentially 2 items to be included in the employment income for the year of income. And here we see payments and allowances, which are ideally the principal sources of employment income. Payments, we are looking at things like salaries and wages. We are looking at leave pay, payment in lieu of leave, fees and commissions, bonus and gratuity, overtime pay. These are typical and they have been listed under Section 19, subsection 1 of the Income Tax Act. Salaries, wages, these are, of course, spelled out in the contract that you sign with your employer. Now, things like leave pay, bonus, fees, now those ones depend on the nature of the job and the nature of the employer. Some employers may not provide this, but the tax law has provided for the treatment of these for tax. Then we have the allowances. We know that you will incur some expenses in the course of executing your tasks as an employee. Now, you're not going to use your salary to meet those expenses. You're going to be given some money. So allowances are the amounts paid to you as the employee for meeting those particular expenses, but the employer may not really carry out a detailed check for most of them to establish if the amount given has been used for that specific expense. The different allowances include traveling allowance, entertainment allowance, can talk about out-of-station allowance, medical allowance, housing, and so on. So these, for example, medical, you could get a medical allowance, money coming to you, but you have not even fallen sick, you've not been ill, but you receive that money. Housing, you could be having your own house, but the money comes in. So these allowances, not all of them, but most of them may not be connected to your duty, meaning that you must prove that part of the allowance or the total allowance was actually spent in the course of performing your duties of employment. If that is true, then that part or the total allowance may be excluded from employment income. So this is the first window. If you're doing tax planning, this is the first window open to you. You can have 100% of the allowance being excluded, or you can have the entire allowance being taxed. So you must be careful with the way you package the allowance, especially for the employers who are here. Okay, the way you grant these allowances. By default, all allowances are taxable. All allowances are taxable. So you must prove that part of the allowance or the total allowance was actually spent. And how do you do that? By providing, you must provide accountability. Okay. So if your bosses are strict and hard on you to provide accountability, they are actually saving you from the tax that results out of the allowance. Because if you don't account for the allowance, then it becomes fully taxable. Benefits in kind. Section 19, subsection 1, part B, widens the scope of employment income to include non-monetary. So it goes beyond the monetary payments that we have seen, moving into advantages, benefits, facilities that you enjoy because you are working for the employer. So some of these include private use of a motor vehicle, which arises where you're provided with the use or there is a motor vehicle available for you to use wholly or partly for your private purposes or official duty. Number 2, we are looking at domestic assistants, housekeepers, chauffeurs, drivers, gardeners, security guards. So you could be allocated a housekeeper and the salary is met by your employer. Number 3, entertainment, meals, refreshments, utilities, the water bill, the car, the internet, telephone, data bundles. Those are all benefits in kind. Low interest loans. This is derived where the employee is provided by the employer with a loan or loans whose total amount exceeds 1 million shillings with no interest or at an interest rate, which is below the statutory BOU rate. Okay, number 6, waiver of debt obligation, which arises where the employer decides to waive a debt wholly or partly. Transfer or use of property, provision of a service. If you're using the employer's laptop, phone provided to you by the employer, this one is a transfer of property to your ownership. Can even be a service. For example, if you're working for professional valuers. You buy your land and then you use the valuation services of your boss for free or for less than market value of the service. That is a benefit in kind. Accommodation includes houses directly owned by the employers or houses that are let by the employer on behalf of the employees. So, of course, all these, when you look at the substance, they are all simply advantages you're enjoying. It's not money, but advantages. The vehicle you're driving, the loan, the housekeeper. So there is need to understand the valuation. So if the taxman has decided to tax these, how are these valued? So here we are saying that the general rule is that the value of this benefit in kind will be the fair value, the benefit on the date it is taken into account for tax purposes, less any amount you contribute as the employee for that benefit. That laptop you're using, if you were to buy it from the shop using your own money, how much would you pay? That's the fair market value. So it means that your employer has actually met the cost on your behalf. So you're enjoying that advantage. So all in all, we shall get the fair value of that benefit. We less any amount you pay, because in most cases, the employer will avail the benefit, but there's a condition that for you to have it, you must contribute a percentage. So we less the amount paid for the benefit to arrive at the value of that benefit. I'll be sharing the slide with you so that you can have all these. For the case of the domestic assistance, it will be the total remuneration that is paid by the employer, less the payment made by the employee, and that will give us the value of the benefit. For instance, if a company pays a gardener 150,000 per month, but the employee contributes 20,000 per month, the benefit derived by the employee is going to be 130. So we get the 20 minus the 150 minus the 20 contribution, which gives us the 130. So the 130 is going to be included on your payroll, okay? As if you have received that money on your account. If the employee does not contribute anything to the benefit, it comes to 150. For the case of meals, refreshments, and entertainment, we shall get the cost of the meal minus the payment you have made, which gives us the value of the benefit. Of course, we see the tax law giving an exception to this, as we are going to see ahead. If the meals are provided for 26 days in a month, each meal costing 3,000, the employee not contributing anything, then the benefit is 78,000. So that is 3,000 times 26. The 78,000 is going to be included on your payroll as earned. Utilities. Here we look at the cost of providing the utility, less the payment made by the employee, and that gives us the value of the utility. Transfer use of property or service. If you're to walk into the shop, how much would you buy that laptop? How much would you pay for that service? Less any contribution you have made, that will give us the value of the benefit. Waiver of debt obligation. The actual relief that has been granted is the value of the benefit. I think I have here something, activity. In the month of January 2021, an employee owed the bank 300,000. The employer decided to pay the full amount for the employee on 31st of January and opted not to recover that amount from the employee. I've not seen this. I've worked for some time, but I've not seen this happening. Anybody who has seen this happening, where the employer decides to pay your loan, your debt, clears the money lender? I've not seen this. I don't know where you are picked this and included it in the tax law. So the employee has obtained a benefit of 300,000 for the month of January 2021, which should be part of your employment. I've not seen this. Huh? Maybe I'm working for the wrong company. I've been working for wrong companies, I think, because I really, if your employer goes this far, this is a very good person, very good employer. Low interest loans, we shall use that formula there. The value is RST minus R times. All this is in the 6th schedule. We shall be looking at that. The formulas are there, clearly indicated. The RST, the statutory rate, BOU rate. Capital R is the rate provided by the employer. L is the loan, and M the months in the year of income. IY the number of months in the year. Okay. On the use of a laptop, what is the assumption? Because I am not using the laptop for my work, but the company work. How can we prove that? By default, those laptops, the phones you're using for the company are all taxable elements. Because there's no proof that you're actually 100% using it for that, for the official duty. There's no, anyway, it is branded, the company logos are there, but you could be doing you could be having a lecture on it right now. You could use it to, type out a proposal for your private use. So the government, what you should know, friends, that the government is a partner. And as we proceed in this discussion and all the discussions that are coming up, you should know that the government, roughly, I should put it at 30%. The money that you earn, the government has a 30%. So you should always focus on your 70%. So why the government is taxing Ian for the laptop he's using is because there is a one innocent, there is a one Derek, there is a one Esther who has not had that opportunity to have a laptop. It could be Ian, the tax advisor, the tax consultant, or let's say Ian, the tax manager of ABC. Let me just actually illustrate here. Let me illustrate why it is like that. Here we have two employees. We have Ian, who has a laptop. He has a laptop and a more sophisticated one. Let's put it at 10 million. He's using a laptop 10 million, very sophisticated. And this guy is manager tax at ABC Uganda Limited. Then we have a one Bruce. We have a Bruce here who has not no laptop. Bruce is the manager tax at XYZ Limited. Now you see, Ian is having an advantage, which is not available to Bruce, but they are doing the same job. Now, if we do not tax Ian for this laptop, we shall be causing what we call inequality. We shall be promoting inequality. This is Adam Smith, not even URA. This is these guys who have studied tax and economics and all that. So if we do not tax Ian, there's going to be inequality. This guy is enjoying a facility, this one is not. They are doing the same job, working under the same conditions, working in the same country, facing the same, So you must be taxed. There's no shortcut to that. You get it? The only problem we have is that our taxman is still catching up. It's playing catch up. You find you have a laptop, there's no taxation happening, you're using a company phone, no taxation happening, you're using a company car. Because these guys are overwhelmed. Those audits cannot be done to the depth. But if we had proper tax systems in place, transparency from the employers, you would really see how taxes actually work. I see Ugandans crying, taxes are high, taxes are high. There's totally nothing here because we don't even have a system. There are so many loopholes. There are so many avenues you can work around, So it is in the law, but the implementation is still lacking. It is all about the implementation. That's why I think most of you have laptops, but you've not paid tax. So you're asking yourself, what is this guy talking about? I've never paid a tax on my laptop. It's because the implementation is very, very lacking. Low interest loans. You receive a loan. Now, this one, the amount also matters because we're talking about 1 million. 1 million would be about 50 currency points. Currency point has 20,000. So if it is a loan, as we see here in the activity, the employer gives an employee a loan in pieces. School fees loan, 400,000. Furniture loan, 500,000. Appliances loan, 300,000. I think this exceeds, this is about how much? This is about how much? Share with me in the chat. If you add up, this is about how much? This is about 1.2. So even if you split it up, as long as it exceeds 1.2, it will attract the tax, especially if the interest rate is below the statutory. So here you can see that the employer's rate is 10%, the statutory rate is 15%. So there's a benefit in there of 60,000. What is going to happen is that we shall calculate the interest and the 15% using the statutory rate. And then we also compute the interest, because the issue is about the interest. The principal, you'll take it back to the employer. But the issue is on the interest. That if you had obtained the loan in the open market from a commercial bank, you would pay interest at 15%. Now, you're able to get the loan from your employer at 10%, giving a saving of 60,000. So this 60,000 is taxable. Again, it goes back to the foundation. Whereas others are picking loans from commercial banks at 15%. For you, you're getting a loan cheaply from your employer. You wouldn't be in position to get this loan if you are not employed. But now, because of that facility, that advantage, you are enjoying it. So the government is saying, give us our tax on what you have enjoyed. Again, with the interest of limiting or eliminating inequality, because this employer is going to cause income inequality if you compare with those that are not able to enjoy the same advantage. Then we have private use of a motor vehicle. Again, this one has a formula. We have 20% times A times B over C minus D. A being the market value of the motor vehicle at the time it was first provided for private use of the employee, depreciated on reducing balance basis at a rate of 35% per annum for the subsequent years. And then we have the B, the number of days in the year of income during which the motor vehicle was used or available for use for private purposes by the employee for all or part of the day. Then we have C, the number of days in the year of income, and then the D, any payment or contribution made by the employee for the benefit. Now, friends, in the examination environment, stick to the number of days. Don't convert to months or years. Stick to number of what? Look out for the number of days, because our C is number of days and our B is also number of days. So just stick to that. Usually students have a tendency of converting to months, something like that. So you need to watch out. The examiners have come out clearly to emphasize that if a formula talks about months, stick to that. Days, you have to stick to that. Okay, so we are going to explore all these. Private use of a motor vehicle is the use of the car for all the time that one is out of official working time. For example, coming from home to the place of work and also going back. This will also include periods like weekends and public holidays, where the employee enjoys the benefit of the car outside working time. This may also include usage on affairs not directly related to one's employment, like picking of school children, or picking bunches of matoke from your farm. So that is private use. Now, of course, for you to be able to have this one exempted, you can make use of logbooks, which record when the vehicle was used and the time when it was not used. I'll be talking about that ahead when we're talking about tax planning. The law also recognizes the fact that there is usage which may not lead to taxation. And here we're saying that the vehicle will not be considered to be available for private use If it is used or available for use by the employee in general for duty purposes, here we are looking at drivers, sales executives, or doing marketing that need these vehicles all the time. And then number two, the nature of the employee's duties are such that he or she is regularly required to use the vehicle for duty outside his or her normal working hours and is not allowed to use it for private purposes. Now, this information must be provided by the examiner because there is no way you're going to know that the person is supposed to use the vehicle throughout. But in practice, as I've mentioned, in practice, you must use the car logbooks. Now, I'm not talking about the logbooks which indicate your name, but there are those car logs. I think I'll be sharing copies here so that you can see how people track movement of vehicles at the workplace to prevent taxation. So in that way, you're able to show that this is a driver, he uses it between here and there, maybe picking someone, and then, brings back the vehicle. So URA is able to appreciate that the vehicle is not available for private use. Then for accommodation, the employer can provide housing to the employee in three main forms. One, the employer could be, owning houses directly owned by the employer, and, you're sleeping in one of the houses. Then we have in number two, houses let by the employer on behalf of the employees, and then housing allowance or reimbursement of rental expenses. So these, in the case of C, the last one, if it is a housing allowance, then there's no complication there. The benefit will be the amount you have received. Like you present your landlord's receipt or invoice, your employer clears the rent. So the reimbursed rental expenses, or simply it could be an allowance. Yeah, you could be having your own home, but there's this allowance that keeps on coming to your account. So that is the chargeable income that's going to be taxed. In the case of A and B, then we shall need to compute where the house is owned by the employer or there is an arrangement for your boss to clear your rent. Then we shall consider the value of the benefit as the lesser the market rental value of the accommodation or housing, reduced by any payment you have made for the benefit, and 15%. So here we shall do some computation. I'll be sharing the exam type question so that we can support the discussion with that exam type question. Employee relief. Now, not all the income that comes to your account is going to be taxed. Some of these amounts are going to be exempt from tax. Pension is tax exempt. Medical insurance, which includes the discharge or reimbursement of an employee's medical expenses, including medical insurance. Like some of you, your employers, they meet your monthly or annual premium. When you fall sick, you're on cover, so you simply present maybe your ID or something, and then they clear. That is not taxable. Life insurance premiums paid by the taxable employer for insurance of the life of the employee, the dependent, non-taxable expenditure on official duty, as long as you can account for those allowances. And of course, the allowance should not exceed what is likely to be incurred. That's going to be exempt, not taxable. Meals and refreshments, we saw this under the benefits, but there is a window for you to jump that tax as long as the meals or refreshments have been provided to all employees at equal terms in premises operated by or on behalf of the employer. Most companies have adopted this very good arrangement. Yeah, as you join the company, you are told that the meals are available, so feel free to always go to the dining to get a meal together with others. So there is nothing like an allowance or, a different arrangement. Everybody enjoys the same meal. So in those circumstances, that plate of food is not going to be taxed. Retirement fund, here we are looking at the employer's contribution to a retirement fund for the benefit of the employee. The employee's contribution is, okay, local service tax. This is deducted before arriving at the chargeable employment income. Then we have other benefits. Any benefit whose value is less than 10,000 during a month, that's not going to be taxed. But this one I don't think is even realistic. Okay, I think I needed to include what we call passage. When you read section 19, subsection 2, it talks about passage costs. Let me just share that on the screen. I think the slide, I missed that slide. Just give me a minute, I share that. Oh, Income Tax Act. This is, okay, there are some changes. This is July, so there could be some changes, but I'll be indicating the changes. But for now, this is the latest. This is the latest tax law in saturation. If I get any other with the changes, I'll be sharing it. Now, I don't want you to use my slides and then you say, you said this, you said that, you said this. These are not my words. This is the tax law. And that's why it is important that we also have a look at section 19 to confirm the discussion that we have just had. I talked about section 19, subsection 1. Subject to this section, employment income means any income derived by an employee from any employment and includes the following amounts, whether of revenue or capital nature. So that's where I got this: wages, salary, leave, payment of overtime, fees, commission, gratuity. So that is section 19, subsection 1, part A. Then section 19, subsection 1, part B talks about value of benefit granted. You see that? Value of benefit granted. Now, these benefits are further listed in the schedule to the Act. Part C, the amount of any discharge or reimbursement by the employer of an expenditure incurred by the employee other than the expenditure incurred by the employee on behalf of the employer, which serves as proper business purposes of the employer. So the expenditure we are talking about here, which is exempt, is that which is incurred by the employee on behalf of the employer, and it serves as serves the proper business purposes of the employer. So it doesn't have an element of private. It's not private. Okay. There it will be exempt, but as you can see, Section 19, subsection 1, part C is very clear that any discharge or reimbursement by the employer of an expenditure incurred by the employee, that is going to be taxed. From time to time, I meet practitioners who talk about reimbursement. Reimbursements are not taxable. Reimbursements are not taxable. Discharge is not taxable. Who told you? As long as you cannot prove, you cannot connect a reimbursement to official duty, it's going to be taxed, even if you baptize it reimbursement. So you must be careful because section 19 subsection 1 part C comes out clearly. And it is talking about what is taxable and what is exempt. Then in part D, any amount derived as a compensation for termination of any contract of employment, whether or not provision is made in the contract for the payment of such compensation or any amount derived, which is in commutation of the amounts due under any contract of employment. Compensation. Again, I find practitioners exempting this, excluding this in the return. That, this was a compensation because this employee left on this ground, so they decided to compensate them. It is not taxable. It is taxable. Section 19, subsection 1, part D comes out to clearly tax, include this in chargeable income. Part E, any amount paid by a tax exempt, okay, this one we talked about it, life insurance. Part F, any amount derived as consideration of the employee's agreement to any conditions of employment or to any changes in his or her conditions of employment. Hardship. Here I want to talk about hardship. Me, I've not been lucky. I've not been lucky. I've not worked for good. Maybe you guys will be since you are my bosses, you'll babysit me because my employers have not been good people. I've seen people earning hardship allowance. Someone is sent to, let's say, I've seen this. There is an employee, I was making an audit and I saw these guys earning hardship allowance. They are sending them to, hard to reach areas. I think the most prominent one was forgotten, but this money could come on the account. Hardship. I was asking, what is this hardship allowance? This is an allowance where we send our employees to hard to reach areas. So given this allowance, but it's not taxable because it is, no, who told you? Section 19, subsection 1, part F is saying that any amount you derive as consideration for the employee's agreement, any conditions that, for me, I've accepted, I'm going to work in this remote area. I don't know which one you can give me. We used to talk about Karamoja, but now Karamoja is a developed, it's now a city, almost it's a city. So, those deep, hard areas, no internet, power is, and someone is being given $1 million to help them, I don't know, to do what. But the law is saying if you accept changes in your employment and you accept that money is taxable, you must pay the tax. So the examiner will be bringing those scenarios. Will bring those scenarios. You must master all these sections. There is no shortcut. You must know. And don't say, the lecturer told us this, he said this. This is the tax law. That's why I've shared the law with you. You must read the provisions and then base your argument on the law, not on what you've heard or what you feel. Some people use feelings. I think this one is non-taxable. I think this one is taxable. Such arguments are not going to work. You must root your argument in the law. You must support your argument, support your discussion with the law. It can be the provision of the act, or it can actually be case law, can be a case. Cases, judges help us in further interpreting this law. Part G, we are talking about the amount by which the value of the shares, okay, this one I'll go into it. We shall have an activity on shares. We need to draw the lines, consideration, then the premium, then the capital gain arising out of disposal of the shares. H, the amount of any gain derived disposal of the right of options. You can you can have a right. An option is a share that you can I mean, it is an instrument that can be converted into shares after a certain period of time. Let's say 3 years. You are granted a number of options in year number 1, on the premise that you're going to work for the company for 3 years. In the 3rd year, you're going to convert these options into shares. So in most cases, there's a gain. Okay, there's a gain. So that gain is also included in the chargeable employment income. I talked about section 19. Now this is section 19, subsection 2. Notwithstanding subsection 1, the employment income of an employee does not include the following. So these are the ones I've been talking about. But I want us to draw our attention to part A, section 19, subsection 2, part A. Passage costs. The cost incurred by the employer of any passage to or from Uganda in respect of the employee's appointment or termination of employment, where the employee was recruited, engaged outside Uganda, is in Uganda solely for the purpose of serving the employer, and is not a citizen of Uganda. So, passage costs are not taxable, exempt. The rest I've talked about: medical insurance, actually medical expenses. Section 19, subsection 2, part B talks about medical expenses. Then part, I think it is part G. No. Section 19, this 8 here. Acquisition, okay. So section 19, subsection 8 explains medical expenses as premium or other amount paid for medical insurance. So you may not see medical insurance in subsection 2, but in subsection 8, medical insurance comes out. So I have shared the act. I'm going to share the slides that I've used for the presentation. I want you to match the two. Confirm whatever is on the slide. Make sure you can make sure to confirm it in the tax law that I have shared. So on the next time we are going to meet, I'm going to give you time. Read the slides, read the law. Then the next time we meet, we are going to discuss. Each one of you will have 5 minutes to present your solution, I should say, your answers, basing on what the law says and the discussion we have had. But before we go there, I want us to have another session where we now qualify what is taxable and what is not taxable. So just give me a few minutes. I share that. Then I'll share the question that will lead our discussion.